only mode.
Good afternoon, everybody. This is Stan for theartofchart.net, and Jack is with me, and we're doing a webinar today on trading with Bollinger Bands and trading with RSI and using them in your trading. And we're going to show you a number of different techniques and tools. Before we start, I think everybody probably already knows this, but our disclaimer, what we do on the Art of Chart is for educational purposes only. Nothing that we present here is in any way a trading recommendation. So we are providing educational materials. We're providing technical analysis of charts, and we hope you guys are learning from this. A couple of things while we're here. I posted the announcements, by the way. A lot of folks have asked about the triple play. So it's 3 services combined in one. You can read up more about that on the subscription page. We have an advanced charting package up and running right now, and we have future webinars that are coming. I think you probably have seen this. This is where we are today, of course, the RSI and Bollinger Bands in swing trading and day trading. We're going to do a little bit of Elliott Wave next time, and on October 4th, for those of you who have missed it, is our first free chart chat webinar. Now, we were doing these for free every week on a Sunday, and that's now a subscription service. So those of you who aren't familiar, you might want to see the webinar on the 4th. So Jack, that's just an overview. I know, by the way, if you are a subscriber, up here at the top, I just want everybody to know that we have a subscriber content button. For those of you with cell phones and those of you with iPads, you click that button and you get this nice little page. So if you're a subscriber, you can click to the subscription that you're interested in, like the daily video update, and here we are on the daily video update page. And by the way, just while I'm here, I'll show you the daily video update page. So here you get free bonus charts, you get a daily video that talks about what's going to happen next on ES, and we have been absolutely killing it lately. I mean, this morning I posted, we're going to, well, actually I posted this on Tuesday. We were going to go to 1895 to 1900, and we've done that. You know, a few days prior, we posted here, we were going to find 41 to 43 as resistance, which happened right there at 6:45 a.m. and down it's gone to 1895 to 1900. So just letting you guys know what we do in the daily video update. We make posts in the morning and we do a daily video, and it's going very well for us at this point. So with that in mind, Jack, I just wanted to do that as an intro. Let's go to the webinar, and you want to just introduce the topics?
Yep, sure. Okay, now what we're looking at today is trading with Bollinger Bands and RSI. On Bollinger Bands, we're going to looking at it with indicators, pinches and expansions. I'll be talking about the weekly pinch that I've been talking about for much of the year as the weekly Bollinger Bands pinch harder and harder and harder. Stan's going to be looking at using them with Keltner channels to identify and calculate on expansions and squeezes. We're going to be talking about band rides, i.e. upper band rides, lower band rides, reversals. Reversals, really, I'd mention retests at the same time. That really includes it.
Yeah, I think that's right.
Yeah, I mean, and double bottoms, and the different ways and the same ways you can use the monthly, weekly, and daily Bollinger Bands. On RSIs, we're going to be talking about RSI divergences, the RSI 14 and the RSI 5, the differences in the signals. I'll walk through how I use them on the various different time frames. Momentum tightening, triangles, trend lines, price cycles, and patterns. Some of these I've never actually seen used, but Stan and I use them on a regular basis, and they really work.
Some of these, I have to say, Jack has some original inventions using RSI, and I have some original inventions using RSI. Okay, so both of us have some proprietary stuff that we do that it's not written about anywhere that I've ever seen. So just making sure that that's clear. So a lot of this isn't book learning. A lot of this is just from doing this, you know. So let's begin. May I start with indicators, Jack?
Yeah, shoot.
All right. Let's go to some indicators. Now, the thing I want to say about trading is this: if you're stuck looking at a chart all day long and you are doing if you're looking at one chart all day long, okay, or if you're looking at one chart at night, I think you're limiting your success, okay? A successful trader always looks across the market. You correlate. You look at other indicators. You look at other things that help you trade, okay? Now, Bollinger Bands on other indicators, it's a very useful thing, okay? Now, I have a picture of the VIX up here. I want to talk about two ways. By the way, there are lots of ways to use the VIX. I use the VIX a lot, but I'm going to show you a couple of ways to use this with Bollinger Bands. I first of all want you to see the Bollinger Band settings I use. I'm using a Bollinger Band of 18, okay? It's 18.2. And I'm using this for a couple of reasons this way. First of all, in general, especially when the Bollinger Bands are holding in the VIX, like right here, that's a sign that you're near the bottom. Okay, it's a sign that you're near a turn on ES. Here's another area right here where, again, we're on the upper Bollinger Band. Okay, now we're not in a rip. We're not in a, we're in this particular case, we're above. We close above the upper Bollinger Band, and we're between the second and third standard deviation Bollinger Band, okay? If you're stuck between the second and third standard deviation Bollinger Band, price is going to run between those two channels on the VIX and also on the S&P and also on ES and also on oil. They all, most instruments, if you get between the second and third standard deviation Bollinger Bands, it goes, okay? But what I'm trying to show you is just a daily thing I look at is where are we on the upper Bollinger Band, okay? Is there room for the market to go lower? In this particular case, there isn't, okay? That's a signal, all right? Right now, look where we are with the VIX. Do you think there's room to go lower, guys? Take a look at where the upper band is. It's up here, okay? There's room to go lower, okay? So make no mistake about it. Did we hit 1900 and 1895 today? Yeah, we did. Did we call that at the beginning of the week? Yeah, we did. Guess what? We're going to bounce, but we're going to probably go lower. And I'm not convinced that we're at or near a bottom yet until the VIX gets up here near this Bollinger Band, okay? So that's one way to use the VIX. Here's another way to use the VIX. It's what I call a VIX sell equities signal. Now, this is a very old signal for those of you who have been around a while. This was originated years ago. Not a lot of people use it because the signals don't happen very often. Now, here's an example. I have it marked on the chart with a line. And on my VIX chart, I have a lot of lines like this, showing where the VIX, where price on the VIX closes below the Bollinger Band when it's set to 18, okay? This is a signal to sell equities, okay? Now, typically, and it doesn't always work like this, okay? In this particular case, we had this rip, okay? And this worked out very, very well. Sometimes there's a 2 or 3 day delay, but a close below the lower Bollinger Band is a potential signal. Now, by the way, it's 80% accurate. Like anything else in trading, nothing's 100%, okay? And if I go to the left here, okay, you will see, here's another example, boom and boom. And by the way, these did not close. This particular Bollinger Band formula on this chart, it's different. And this is the other thing, guys. When you go across trading systems, you got to check out your formulas. Okay, this trading platform, the standard deviation calculation is different than my other platforms. So here and here, we closed below the second standard deviation Bollinger Band set to 18, and we got this rip. Okay, so again, this doesn't happen very often. We've had what, 5 signals in a year. Okay. But it's a very reliable signal. And anytime you find something that's a 70% signal or an 80% signal, I don't care if you get it 3 or 4 times a year. You keep track of it because it's a very valuable commodity as far as I'm concerned. So that's an example of the VIX put-call ratio. Okay, that's another one. Here's put-call ratio for the S&P 500. I check this on a daily basis. My settings for Bollinger Bands, okay, 21s. Okay, the put-call ratio on the S&Ps, whenever we punch the upper band, you can see I have lines every time we punch the upper band. Now, for whatever reason, I don't have one here. I should have one there. I just haven't updated the chart. But this is a potential signal for a reversal. Okay, now, of course, I never look at just one signal. This is one thing I look at with 5 or 6 other things at the same time. And when they all line up, guess what? It's a great trade. Okay, so that's how I trade. I look at multiple signals. When they line up, guess what? That's a great trade. So again, I use Bollinger Band width. Now, what this is tracking, Bollinger Band width, if you're not familiar, it's tracking how the bands expand and contract. Okay, and we'll show you when we talk about band rides how Bollinger Band width is very useful for that. So these are two signals that you need to look at, and I use Bollinger Bands with these because it's really giving you a sense of when you're at an extreme. Okay, and as a trader, you want to pay attention to extremes because that's where the opportunity lies in trading, is when you're at an extreme, and learning how to recognize those extremes and using, Bollinger Bands is one tool to do that. So that's my quick intro to other indicators other than price, Jack. And let me pass it back to you so you can cover a few things on Bollinger Bands, and I'll have a chart set up here with Keltner's in a minute, hopefully.
All right. All right, hang on. Just moving a chart over. Now, let's have a quick look at this. This is a series of SPX charts, but the sugar one I'll be using later when I'm talking about patterns on the RSI. Let's have a look at Bollinger Bands, and let's look at compression. Now, this chart, if you've been reading my blog, you'll be very familiar with this chart. This is the SPX weekly chart, and what I've marked on here is Bollinger Band pinches. Now, what a Bollinger Band pinch is when the level of activity is reduced to a level where the Bollinger Band is compressing. Basically, what you're doing is you're building energy for a move, and we built a huge amount of energy for this move throughout this year. You can see we were trading in a relatively tight band for 7 months. 6 months at least. It's and we actually I went back and looked at the stats on this. I think hang on one second. The level of compression on the weekly chart had reached on the weekly chart had reached on Monday the 17th of August was almost unprecedented. The weekly bands were just 64.5 handles part, or 3.067%. You've got to do it in percentage terms because over a 20 or 30 year period, obviously the change in the value of the price of the SPX has been enormous. Since 1970, this has only been exceeded once by a 3% compression in 1994. So basically, it's almost matched a total freak, which is the only example in the last 45 years, which exceeded it. And we had a big move after all of these. I was talking about at least 8%. Well, obviously, we've had that. It didn't have to stop at 8%. Obviously, a number of them went quite a bit further. This one, I suspect, is going to go quite a bit further too. But if you look at here, this is very, very, it's getting narrower and narrower and narrower, and then it breaks. Now, which direction does it break? Unfortunately, it doesn't tell us. It could go either way. Any compression can go either way. What you have to do is work out which the likely direction is going to be. And I think I was saying, well, I said a number of times that realistically, given where resistance was, which on this channel up here, the only way where there was likely to be enough room to see this expansion was going to be down. And indeed, that's exactly what we've seen. This is, how do you come across stats like that? Well, actually, there's nothing stopping you from just developing them yourselves. All you have to do is look. Every stat ever generated was generated by someone who just went back and looked. If you're thinking that seems unusual, I wonder how often that happens, you just go back and look. That's what I did. I just ran back. I've got the stock chart service that goes back a long time, so I've got weekly data going back, solid weekly data going back to the beginning of 1970, so I just went back and looked back to 1970. That's it took 2 or 3 hours. I didn't produce a neat. If I'd wanted to do a neat spreadsheet, that would have taken a while longer, probably a couple of days actually, to put all the data into it. But the reality is, judging by eye, and going and blowing up the every time you had a pinch, which was interesting, and just measuring it. That's not hard to generate things like that. You do not have to rely on books. TA is, in my view, the ultimate practical discipline. You really can test things out. If they're not as advertised, you toss it in the bin, or you make a variant that works better. It's not hard to do that, and that's why Stan and I will be showing you quite a lot of stuff that you won't read anywhere today, and that's because we've experimented. And that's how you come up with decent methods. That's how anyone ever came up with decent methods.
Absolutely, observation and trial and error.
This is it. So it's not something that you have to be, in the TA Hall of Fame or famous authors, or you have to be dead and white and old and whatever. It's to do. Anyone can generate.
I love that, Jack. I love that. That's great.
You just need. Well, the thing is, a lot of people have got too much respect for the canons, and I mean, seriously, past TA writers, they've done a lot of really good work. But the fact is, did they know everything? No. Were their tools as good as the ones we have nowadays? No, not even close. The reality is, they're doing really well given the tools they had at the time. It's quite a lot of the stuff that they've written is wrong. They were using best hypotheses on things that they didn't have time to test thoroughly enough. I've gone through a lot of the trendline rules, and there's a really, really stupid rule. Just digressing briefly. There's a really, really stupid rule that you can't use a trend line which has been in a... Right. You cannot extend a trend line back from a downtrend into an uptrend. Now, I've got an example on the sugar chart. That would mean that I wouldn't be able to pull this trend line back into part of an uptrend. But it's garbage. It's absolute bollocks. It's, the theory is that they're separate entities, but the reality is, what is a head and shoulder pattern other than a meld of the end of an uptrend and the start of a downtrend? The reality is, some of the best sources for trend lines come from exactly those areas. So you test it, it doesn't work, you discard it, and you move on. And the reality is, that's not a criticism of the people whose books you have written and whose work you've been experimenting with. The reality is, nobody is perfect, and no one gets it right all the time. Anyway, back onto Bollinger Bands. Now, after you have a period, and Stan's going to be talking more about this as well, but after you have a period of compression, you can expect a period of expansion. This is the compression, and this is the expansion. There is often a correlation between the amount of time you spend in the compression and the amount of time in the expansion. This suggests that this expansion has quite a way to go yet, and I think that's almost certainly right. Right. Okay. What should we talk about next then? Do you want to go?
I almost have my chart ready. If I can do a little Bollinger Band tutorial with Keltner channels, which is always a very interesting, situation. Okay.
Right.
Can you pass back the chart? Yeah, I'm ready.
Yeah, okay. Yeah, good. Yeah, cool.
Okay. Here's a trading tool that I use a lot. And by the way, this is on my other trading system, and I just got it set up. I'm talking now about using Keltners for expansions and squeezes with Bollinger Bands. Now, let me kind of define this for you, okay? First of all, do you see the red channel here, okay? Those are Keltner channels, and basically my Keltner, the number of days in my Keltner calculation is 20. The factor I'm using is 1.5, which is basically a standard deviation factor. Now, Keltner's is a completely different formula from standard deviation, okay? And standard deviation tends to move more quickly. Keltner's tend to be more stable. So you see on my chart right here, and let me make this a little larger so you can really see it, okay? When you have Bollinger Bands, which are the dotted blue line, okay, when you have the dotted blue line, let me make that a little bit bigger. I'm trying to make it bigger so you can see it. When you have the dotted blue line come inside of the red channel, okay, you have compression. You have serious compression, okay? Now, this can happen on a daily basis. This can happen on a 5-minute basis. You're looking right here at, what am I looking at here? I'm looking at SPX, and I'm looking at a 3-minute chart. Okay, so you can use this day trading. There was a guy that asked me once in a seminar, how do you trade the end of the day and how do you look for a squeeze? This is what I do. I look for the blue dotted lines to come inside of the red line. Okay, do you see that? That's compression right there. When that compression happens, there's an expansion that follows. Look at that expansion. Okay, that's a rather large example. Okay, usually they're a lot smaller. Like right here, it doesn't quite get compressed, but you get an expansion in the Bollinger Bands. Okay, here we're definitely compressed. You get an expansion in the Bollinger Bands. Okay, I'm trying to find another example here, and all you have to do is do this on your charts, guys. Okay, and look for compression and expansion. Okay, here's an example where there was compression. Bollinger Bands are crossed inside of Keltner's. What do you get? You get a little expansion. Okay, let me do another one here. I'm sure, I think you get the idea, okay? I hope you get the idea because Keltners, especially if you're day trading, very valuable. Now, the other thing, and I'm not sure if I can show you this, but on a daily basis, from a trading perspective, this is extremely valuable, okay? Like for example, right here before we had this big fall, okay, Bollinger Bands were well inside of Keltners, and I said, we have a big fall coming. And this is one of the things I look for on a daily basis. Are you inside of the Keltner channels? And if you're in, and you're inside the Keltner channels right here, right before this fall happened, okay? And you can if you plot this, by the way, and you can count the number of days that you're inside of, you know, a Keltner channel. Like if you're inside of a Keltner channel for 7 full days, you can expect at least 5 days of expansion. You can expect at least 60, 70, sometimes 80% of the number of days of compression. You can expect that many days of expansion. Now here's the hard part, okay? When you're compressed like this and you have Bollinger Bands inside of Keltner channels, okay, you have no clue what direction it's going to go in. Now, of course, there's no guarantee in trading that'll go in the direction that you want. But if you have other indicators and you have other ways of looking at the market, you know, we were looking at a downtrend being possible and a break here of it's not on the chart anymore, but 36s or whatever. And if we broke below that, it would be a correction and all that kind of stuff. So, you know, we had talked about that. But looking for compression and expansion, if you don't know what compression looks like, okay, there's a way of looking at compression, and let's just look at a daily chart real quick. And I'll jump to, I'm going to jump briefly to RSI, Jack, and we'll come back to it later. But, you know, the thing about Bollinger Bands is pinches and also getting inside of Keltners, it's a sign that there's a great trade coming, okay? So use that to your advantage. This is the other trick, is looking at compression in RSI. We talked about this triangle. You know, I felt like, Jack, we were talking about this for 6 months. I got tired of talking about it, but you know, yeah. this is a compression. Okay, this is a triangle, an A, B, C, D, E triangle. This is compression. Jack was talking about compression on a weekly basis in terms of Bollinger Bands pinch, and I was talking about look at RSI and how it's pinching. This is a sign that there's a big move coming. Okay, and so so I wanted to just mention those couple of things. If you look at an hourly chart on any instrument, let's look at something different. Let's look at the Russell. Okay, if you look at the Russell, and whenever you see a pinch, here's a pinch, there's usually an expansion that follows. Here's a pinch, there's an expansion that follows. Just look at your system and look for pinches. Overlay it with Keltner channels and learn to trade expansions. That's where the money is, okay? Throwing something on just to throw something on is no way to make money. It isn't, okay? So, you know, have tools that help guide your trading. So how have we done on Bollinger Bands, Jack? We want to spend roughly 30 minutes talking about this stuff. And guys, by the way, put in questions, okay? We'll answer your questions at the end. But we maybe
there are two things I'm particularly keen to talk about. You need to do a quick bit on double bottoms. We also need to talk about trading within the upper range or the lower range within them, and we want to talk about band rights.
Okay, why don't you do the double bottoms and the range thing, and I'm going to get a chart set up with Bollinger Bandwidth, and we can talk about band rights.
All right.
Okay, you have the con.
Okay, now hang on, just make a quick change on this update. So I'm just putting in a fresh SPX chart here, and I have managed to, hang on, just putting Bollinger Bands back on, solid thick, color black. All right. Let's have a look at the way price behaves within it. Now, one thing you've got to remember about a Bollinger Band is the Bollinger Band, it's not a mystical thing that someone once dreamed up, etc. It's a really, really simple mathematical tool. The middle band is just the 20-period MA, and the standard bands used are 2 standard deviations outside. If you want to use and this, you will often see these on my charts. If you want to expand that somewhat, then you can add the 3SD bands. So let's go with solid, thick, and red on those ones. So just add those. It really is, just as easy as ABC. There is nothing complex about this as a mathematical tool. This in red are the 3SD bands, and you will notice that we don't tend to get below the 3SD band terribly often. This recent decline was one of the rare exceptions to that. Generally speaking, if you get above the daily upper 2SD band, you're looking at a pretty serious opportunity if you actually manage to hit, certainly on a buy, because you get more extreme moves on the sell side. On the buy side, if you manage to hit the 3SD band, it's an instant sell. You can see there, come in, hit it, sell it. That's you will often see things happen like that, and that's exactly what happened just before the serious decline last October. Now, when you are trending, which doesn't actually include any of the period on this chart, so I'll just change the period. Let's have a look at 2013. That was a classic year for trending. Let's look at second half of 2013, and let's look at the first half of 2014. Right, here, in a trending market, you will find the middle band will tend to be good support and resistance. You will often find it come back and test the band and then move up. Or if it breaks down, this is something I've talked to quite a few times, if you have a breakdown, you need a confirming candle the next day. Yeah, this is a breakdown which has a confirming candle, and it goes straight down from there. This is a break up that had a confirming candle, i.e. it didn't reverse back through it. This is what it looks like when it reverses. Hang on, here. Just blow that up and have a quick look at it. This is something I've talked about many times. What you're talking about is you have the break through it, and then you have a reversal candle the next day, which basically reverses most or all of the previous day's candle and re-breaks back with confidence. Generally speaking, you have to respect that. That will effectively cancel the break. Watched many of these, they happen very regularly, and when you get the reversal candle the next day, then the immediate downtrend or uptrend or whatever the break signified is dead. All right, looking here, got in a good uptrend, you will spend your time trading within the within the top half, generally between the 20 MA and the 2SD upper band. Here, very nice. A little nicer from a trading point of view if it come back and tested here. Here, it's come exact retest, gone back to the top. You see that happen a lot. Equally, if you slightly less interesting from a trading point of view, but again, very tradable. When you are, what is very bullish when you're testing the middle band, going right through it and then holding it. At the close, there was a weekly close I did a post on a couple of years ago where we did exactly that with the weekly middle band on a big trend. Everyone was expecting it to go lower again, and it was a rare candle. I ran the stats, and I think I got over the last 40 years, I think all of them had gone up over the next few weeks. And I think only one of them had a negative week the following week. I think out of something like 12 examples. So I said, it's the downtrend is a write-off. We're heading back to the upper band, and indeed we did, because you never know what's going to happen in the future. But the reality is, if the lemmings ran off a cliff and they all ended up in a broken pile at the bottom last time, then there's a reasonable bet, or at least a working assumption, that's going to happen when they do that this time. It's these work exactly the same way. As soon as you see something rare, you can check it. It's and that's what I do on a very regular basis, and that's how I come up with some very cool stats. Right, band rides. Sometimes you basically get embedded on a trend, and you've got a 1, 2, 3 features of a band ride. You will come close or touch the upper or lower band every day during a band ride, and when you come off it, you will generally be headed back to the middle band. This is a classic example here. Got 1, 2, 3 just short, but back on it the next day. So that's 4, 5, 6, 7 you get your negative day here, falls away with a heavy candle the next day, and heads straight back to the middle band, and then goes through.
Yep. I have
Generally speaking.
Just add to that, I have a chart to show, well, using band width to actually predict band rise.
Shall I throw the chart back to you?
As soon as you finish, whenever you finish band rise, I want to show one chart on band rise.
I think on the band rise, again, watching the 3SD band, lower and upper bands for opportunities. If it gets, particularly on the buy side, if it's extending right through, you tend to be fairly close to the top. You see an extension right through. This is called the Bollinger Band punch, which, if you've been reading my post for a while, you will recall me talking about. Bollinger Band punch. This is relatively early. You've got to pick your times on these, but again, punch, reversal, punch, 2-day reversal. It's there are some very nice opportunities anywhere testing the upper 2SD band, and particularly if you get anywhere near the 3SD band, tends to be a fairly quality sell. It's and the band rise. This is a nice one here. You've got 1, 2, 3, 4, 5, 6, 7, 8, 9. And you can see, actually, on this one, got a very classic, it touches the 2SD lower band every single day. Touches it once there, through it, tests it from below there, trading through it, tests it from above there, tests it again from above there, goes through it again, Bollinger Band punch, touches the 3SD again, and again, if you touch the 3SD the first time on a decline, that's often going to, well, I mean, you're going to be fairly close to a rally. Touch it again, chances are you're nearing a significant line.
The second touch is the key. Yeah, I agree with you.
Okay, great. Shall I throw it back?
And by the way, Jack and I have never compared notes like this before, so this is very interesting just to hear him talk about band rides. Yeah, sure, go ahead. I have one thing to add, because I wanted to show an indicator that some people use, some people don't use. But if you're going to use Bollinger Bands in your trading or in your technical analysis, you should be using band width. Okay, so what I have here on the bottom of the chart is band width. On the top of the chart, I have Bollinger Bands, and here's a small little band ride. By the way, nice little band ride. It's like 7 days. How do you know that that's coming? Well, first of all, you can see the pinch, right? The Bollinger Band's pinch, but what happens to the Bollinger Band width in a pinch? It gets very narrow. The red line on the bottom is 1.5, the line at the top is 5, okay? So I see it around the 1.5, I say, compression, a pinch. I throw my Keltner channels on. I'm inside of Keltner's. It's like, expansion is coming. Which way is it going? I don't know. I wait for it to initiate. You see, it just starts to initiate. I get on board, and as long as it's touching the Bollinger Band, every single day I stay in the trade. I don't get out of the trade until we're off of the Bollinger Band, okay? So, or at least on the way down, I'm legging out, okay? And I don't really get out of the trade until I'm at least at 5, okay? When I'm at 5, I say to myself, well, this might be a good place to take a lot off, and I'll be small trailer size, right? Now, it doesn't always work, guys, because here's an example where we were at 5 again, and we're all the way down here. That's a pretty good trade. We had a pinch right here. Look at that pinch. Isn't that a great pinch? I mean, God, that's a great pinch, right? And here we are. We're starting to trend up bandwidth wise, and we're on the lower band. Touch of the lower band once, touch of the lower band twice. Look what we did. We hit the middle once, we hit the middle twice. That's like an invitation to get short, okay? Bollinger Bandwidth trending up. It's like and the upper band is resistance. You got to be kidding me. That's a trade. That's a great trade, okay? And you stay in the trade until you're at least at 5. Now that right there, guys, from where we would initiate that trade, I just want to show you this, okay? Because Jack and I traded this together. So this is 1997, all the way down to where this hits a 5. The low on that day when we hit the 5 on this was, what's the low there, Jack? I'm sorry, that bar. That was like a 90 handle trade right there. Just trading Bollinger Bandwidth, okay, and riding the band. How do you make money as a trader? You make money staying in a trade. You don't make money getting in and out of a trade, okay? Nice. So this is a hold. Look at the hold, okay? We would have got in here, right there, right? And we would have held that 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days, 90 handles, okay? Just using a simple rule that, you know, you pay attention to 1.5 and 5, right? Do I get all of the move? No. Do I care about getting all of the move? No, I don't. Okay, why would I? I'm up 90 handles. If you're not happy with that as a trader, you know, you shouldn't be trading. Okay, let me just say it that way. So bandwidth is important to look at for band rides. Okay, now this is an obvious band ride. Okay, the one we just went through. So I'm not going to talk about that. But you know, you got to look at band rides, and you got to look at Bollinger bandwidth. It's a dead giveaway, guys. It's an easy system to use. So use that in your trading. Okay, so let's go back to the outline, Jack. And I know we always put a lot in these outlines, and we never get through it all because it's like a tight timing. But yeah, we've done band rides, reversals.
Divergences. Shall I do divergences?
Yeah, let's talk RSI. Okay, I'll throw it back to you. You initiate RSI, and I'll follow. There you go.
Right. Okay, let's have a look at the chart I use. Well, actually, this is a very good example. Actually, this is a very good example of quite a number of features of RSI, because one thing, if you want to see how I use RSI, actually just look at the charts I post every day. And they are extensively marked up. What do those markings mean? Well, wherever you see one of these red lines here, yeah, this is, I'm moving over to this. I haven't got all the charts on the system yet, but I've got most of them. The red lines are RSI 14 divergences. The green lines are RSI 5 divergences. What is a divergence? Now, I've had this question a few times. It seems obvious, but actually, until you hear the answer, it isn't necessarily obvious. And what a divergence is here, you've got a positive divergence on the RSI 14. What does that mean? That means that we made a lower low on price, and we made a higher low on RSI. And it's just as simple as that. I was asked today whether we had a daily buy signal brewing, and I said no, because we couldn't have one until we at least retested the 1867 low on SPX, because you cannot have a divergence without an actual, or at least a matching low. If you have a matching low and divergent RSI, then that means something. If it hasn't made a lower low, there might be divergence, but basically it's not really in a state where it's usable for buy and sell signals. It's I will occasionally use, my rules for these cover the divergences. You only start looking when RSI has either reached 30 or 70. I will occasionally break this rule, but not very often. That's for short-term trading. Occasionally, I'll break this rule for short-term reversals within. But basically, if you look at here, and divergences aren't always immediate either. You get I've had a sell signal trigger here, then a sell signal trigger here, and you can see it's continuing to make new highs on increasing negative divergence. It then spikes up and does, and this will bring us on to the patterns area later, because you also get patterns on the RSI, and this is a double top, and it behaves like a double top. You will also get head and shoulder patterns, you'll also get wedges, you get support and resistance trend lines. You can see them marked all over here. RSI is a wonderful tool. But again, it's not black box or anything, it's just simply a way of measuring momentum. But it charts beautifully. And for trends, for triangles, it's incredibly useful. If you're talking about an extended trend, you will find that you will have a series of, let's say, lower lows in this instance, where you have increasing amounts of positive divergence. Do I count? One other thing to mention on divergences is when it reaches, basically, when it gets over 60 or under 40, it resets. So if you get, if I'm looking at divergences unless RSI gets over positive divergences unless RSI gets over 60. After that, you disregard it, because the reality is you're not looking at divergences between here and here. You're talking about divergences within the short-term trend on whatever time scale you happen to be looking at.
That's right. I think that's a mistake. That's a mistake traders make, and I just want to say that divergence doesn't happen until the impetus move is over. Okay, there's an impetus move, which is the, when RSI is at its maximum, like for example, if you're into EW, that would be the third wave, or that would be the B wave, or whatever, right? That's when the divergence starts. And so there's always momentum waning when you're making the final move higher, okay? in a formation. But by the way, there are corrective states where there is no divergence. Okay, so and we need to talk that through as well. But
Sure.
yeah, please continue, Jack.
Yeah, but the thing is, when you are talking, if you're looking for divergences on this RSI 14, this is a trend, that is a trend, this is a trend, that is a trend, this is a trend. You are looking for divergence within that trend. You're never looking outside it. It's you're not comparing this to that. You might be comparing them on a larger time scale, but you're not comparing them on this one. There can be no divergences between here and here. They are separate trends on it. So you disregard those, and you disregard anything where it hasn't hit the 30 level or the 70 level. You only start measuring it then, and you accept the fact that sometimes a trend will continue, and you will get an increasingly strong sell signal. And here you've got an increasingly strong. What have you got to measure it with? You've got the RSI support trend line. When you get the breakdown there is when it's going to go, and it doesn't break down until it does the double top and hits it, and then it goes down properly. Right, okay, so that's how you measure divergences quickly.
Okay.
I'll probably get a few questions about that. There was quite a lot of information in there.
Okay.
But again, how have I developed that? Well, I mean, the answer is how to calculate divergence is pretty straightforward. I just worked it out for myself. It's I have read books or extracts from books where it talks about only counting the lower low, let's say a lower low on price and a higher low on RSI, and I think that's just purely common sense. The reality is, otherwise there is too much judgment involved to make a sensible decision.
Mm-hmm.
Right,
I have a couple of RSI examples I want to share too, Jack.
All right, shall I do, next on the list is 14 and 5 differences in signals.
Yeah, if you want to cover that, sure.
Right, I can cover that really quickly.
Yeah, sure.
Right, okay, here you have, obviously I've marked in green divergences on the RSI 5, and I've marked in red divergences on the RSI 14. If it's divergences on both, I've marked it on the 14. The 14 is the larger degree, i.e. you are talking about the main trends here, you are talking about bigger signals. It's and bigger moves. RSI 5 will give you an awful lot of much more sensitive moves. And
if you're a shorter term trader, you should be using an RSI 5. If you're into swing trading, a 14 is much more suitable. Actually both together I think is great, by the way.
Yeah, I think I use them all together. What do I use the RSI 2 for? It's a useful empty space where I can put text. So it's not actually useful for much else, as far as I'm aware. But these are great. They work on pretty much any time frame. In fact, I tend to run 1-minute charts all day, every day, and I run a lot of signals on those. I don't tend to mark the RSI 5 signals on those because actually those are on the 1-minute chart. Those are here and gone in a couple of minutes a lot of the time. It's but I'm using the channels a lot. You see a lot of the main turns on these, and you can see RSI trending as well. It's I will use a similar setup on. I will use identical setup on RSI and identical setup for working out signals on monthly charts to 1-minute charts. It's always similar. So the only difference is if you're using weekly charts, you will often find that things are going to have more trouble making targets, I think, partially because of inflation. Over the very long-term charts, that becomes a consideration.
10-year charts, sure.
All right, great. I'll throw it back to you, mate.
All right, great. Thanks. And I'm aware that we said an hour. We got about 15 minutes left. What I want to add to what Jack said is I'm going to talk a little bit about trend lines and price cycles and also momentum tightening in triangles. I think I've already covered the momentum tightening in triangles piece. Let me just kind of show you the daily chart on SPX again. Look at that tightening of RSI. That's the sign of a triangle. If I went to oil, which we don't have time to do, I could show you oil triangles, okay, on multiple time frames where you get a tightening of RSI inside the triangle and then an expansion, okay? What creates the thrust out of a triangle, okay? It's the compression, okay? You can see that in RSI because RSI is what? RSI is a momentum tool, okay? So when momentum contracts, you will get an expansion. So, you know, if I'm looking at a 1-minute chart and I'm looking at a triangle, that's very different than looking at a daily chart. Okay, look at the expansion we got out of this daily chart. Okay, very It's a very classic example. Okay, so I won't talk anything more about that. I think we've talked that one a lot. Let's talk about let's look at like RSI trend lines. Now, this is something that I've been playing with for years, and it's amazing how it works, because here's an example of, here we are in an uptrend, right? And we knew that there was going to be a test. We were talking earlier about how we were expecting, like, 2020, roughly speaking, 2000 as a back test on the S&P. And here we were looking at like the monthly pivot and potentially 84s to 88s, and we have those two targets marked here. We were talking about that all the way down here, okay? And what did we do? We drew an RSI price cycle, and we said, as long as we do not break this cycle, we will go higher. And that's what's happened. We worked our way higher, and finally we broke it. Now, I want you to notice something here. Where did we break it? We broke the RSI price cycle before we broke the monthly pivot. We broke the RSI price cycle before we broke the price trend line, okay? This tends to break before other indicators. It's an early warning sign. Okay, sometimes the break actually doesn't happen like this, where there's this much space. Very often it's tight. Okay, when it breaks, what do? I put a trend line in the opposite direction, and I'm staying. This helps me stay in a trade. Okay, so this helps me stay short. Okay, and I wait. It back tests. And by the way, look at this back test. Isn't this gorgeous? We have this price cycle. What very often happens is you back test it, and that's a sign to put something on short. It really is. Okay, and away we go. Okay, and so if I can look at that on the NASDAQ, same thing. Look at the cycle. Okay, where did we break the cycle? Right there, before we broke the trend line. Okay, again, before we broke the monthly pivot. And where did we break it on the uptrend? Right there, and that's right at the monthly pivot, right? So this is basically a signal that we're in a retracement, okay, which we were expecting. And I can show you another one on the S&P. S&P, same story. Look at it. Okay, so cycles, price cycles, and this is what I call a price cycle. And by the way, I marry price cycles to wave structure. Okay, and so it's a very useful tool for staying in trades, and you can use it on different time frames, and it works. It works daily, it works hourly, it works on a tick chart. It works. So use it in your trading. I don't think that's not something I've seen commonly talked about. Jack, did you want to do, and divergences, I'll add to what Jack said about divergences. Divergences are very, very useful. Let's look at a couple of divergences. I'll tell you what, let's just look at the S&P. It's probably the easiest one. The classic divergence, let me see if I can find one on a daily basis. Yeah, I'm fresh out of divergences. How about that?
I've got a load.
Yeah, I bet you do. Yeah, I'm sorry. I'm kind of doing this way. Okay, here's a very, very decent divergence. Now, the thing I want to show you about this divergence on this time scale, this is an hourly scale. And when I look at an hourly chart, I'm looking for an impulse, okay? I'm looking at an impulse, I'm measuring the impulse. This is a 5-wave move. Where did we get the peak of the impulse? In a small structure like that. We got that at the top of I would call that that's a third wave or a Y wave, okay, depending upon the fib measurements here, right? And you get the back test, and then you get the 5th wave, right? Where I have C marked, okay? So that's a 5-wave up structure, okay? And look at the divergence, okay? There's a divergence there. That's an instant short in my book, okay? And by the way, what you have to also watch for is a break of the divergence. We showed gold earlier this year, where we had a beautiful setup, beautiful divergence, and the thing we said was, if the divergence breaks, get out of your trade, because that means that the 3rd wave isn't over yet. Okay, so there's a 3-5 divergence whenever you have a 5-wave structure. And that's just something to pay attention to, and we'll get more into that next week when we talk about Elliott wave. So, Jack, given the time, we talked about patterns, right? Let me throw it back to you. You do patterns, then we'll take questions. We got about 10 minutes here. All right. There you go. Patterns next.
Right. Let's have a look at patterns. Now, first, I'm just going to cover something that Stan was looking at, and that's just my view on triangles. We had a beautiful example, which I would like to show you over the last day. this is SPX. This is the in red is the little falling wedge I was looking at yesterday. We broke up to the 23.6 and it broke down. We formed a triangle. I posted. I think I posted on. Can't remember whether I posted on Twitter last night. I posted in our charts that we sent out to subs. It's but this triangle here, it is mirrored by a triangle on the RSI. You can see it breaks down here too. We get the thrust. You get a slightly dodgy-looking inverted head and shoulders here, but you also get, and this is something that Stan has talked about. If you've watched a number of chart chats, you've heard him talk about it many times, which is you get the thrust out of the triangle, and then you get the retracement. What a beautiful example!
Oh yeah, gorgeous example. That's just classic example.
Just beautiful. And again, combined with RSI, what do we get at the bottom? We've got a divergence. It's a beautiful 5-minute bicycle. It's goes up, off you go, and that was really the last day on RSI. Beautiful, absolutely lovely. It's and we're going to see some retracement here, I think, because that's broken this uptrend here, and this is looking.
Yeah.
Well, this is either a bull pennant or a small double top. So I'm thinking it might go down a bit and then up again. Right, so that's a beautiful example of a triangle. What about other patterns? I was looking for a particular pattern, and it was on sugar stem.
Yep.
Here it is.
That's a good one.
Yep, falling wedge.
And there's a triangle wedge.
Falling wedge. They don't always match. Sometimes you'll get a triangle on the main chart, and you'll get a wedge on the RSI, or vice versa. But these are very, very tradable patterns. This one I've been watching for months. I've used it in chart chat many times. And what I was saying was, when this wedge is coming close to the end, this will break up. And it broke up a couple of weeks ago, and this is very close to the low. And you can see from the pattern structure, you'd expect that too anyway. We are expecting, I think, another low, or at least a retest of this low. But this is close to a bottom on this pattern from 2011, and there's a very nice buy lurking around here somewhere. But again, beautiful RSI pattern. Used it for the divergences, and actually on this breakup, you've got actually a divergent low at the bottom. You've got a lower low there. You've got a higher low here on RSI, and then it's broken up. Classic. Absolutely lovely. In terms of other patterns, sorry, still got a bit of this bug. Anyway, this is again another beautiful triangle, place triangle. You've got this is on the 15-minute chart. You can see we've had a number of decent trends here. What have they all got? They've all got RSI resistance and support trend lines. When it starts getting choppy, that stops. But if you're getting smooth moves from the bottom to the top, you will get RSI support trend lines. And then when they break, the writing is on the wall. It's reversing.
Yep.
It's, you will often see that break before the price breaks.
Yeah, absolutely right.
An immensely powerful tool.
Yeah,
you have to, like any tool, you need to use it with some caution. You need to be aware it doesn't.
You never use it. You never use it as just one tool. It's one of many tools, and when they line up, then you have something. Okay, so that's the main thing. Any one tool taken out of context can kill your account. Just keep that in mind.
Also, the other thing is, like any useful tool, learn how to use it. When I was talking to people about divergences, then when they were saying, "Oh, well, is this divergence? Is that a divergence?" Find out what a divergence is, and then use that. A divergence is when you've got price goes one way, makes a higher low, and a lower low, and then RSI makes a higher low, or vice versa. That's how you get your divergences. Ignore the rest. Most of the rest is just noise. It will only confuse you. When you get something like this is a double top. It will play out just like a conventional double top. You will also see head and shoulder patterns.
That's a great. This is a great tool for double tops. When you see that on RSI 14, it's just a giveaway signal. And by the way, there aren't very many giveaway signals left. I mean, there used to be more, and the market changes over time. So you got to use what works. And if stuff goes away, then you got to find other stuff that works.
Yep, because the reality is, as I said, this is a very practical discipline. Find out what works, test it. If it doesn't work, dump it. Use something else.
If it doesn't work 60% of the time, throw it away. It's got to work 60 at least. If it doesn't, throw it away.
You haven't got to do it by the book.
Right.
You can find out what works. You can experiment, and
it's
easy.
There is no book. Throw the books away. You gotta learn through trial and error and observation, and keep your own stats.
Yeah.
Because what's written in books is written for a market that was whenever it was, okay? And the market we're trading now is not the same market. It's like putting your foot in a stream. You can't put your foot in the same stream twice. It's different.
It's also, you can't use these things exactly the same across the board. And the reality is all the markets are different as well.
Yeah.
If you're working extensively with moving averages, which we'll probably do a webinar on some other time, but I mean, if you're working extensively with those, you will find that different moving averages are important on different charts.
Yeah, right.
A classic example is gold, where the 150-day moving average is a very, very, very important support and resistance level. Yep. Where else have I seen that being useful? Nowhere.
Yeah, right.
But it's useful on gold.
Every instrument has its character, but there's some of these tools we're talking about, Bollinger Bands, Keltner channels, using RSI. A lot of that actually does go across. I mean, like
no, it does.
Yeah,
but you will find everything's got its own nuances.
It does. It does, absolutely.
Everything has its own little quirks. You will find that. The thing is, one thing I run if I'm running a new instrument, I'll look at all the past RSI signals on it, and I'll see how well they work. If they are a piece of sailing, I won't be paying a lot of attention to them.
Yep. Absolutely right. Absolutely right.
If they all deliver, I'll be paying a lot of attention to them. So you work out what works. The first thing you do is you look at it and see if it works.
Yep.
It's generally very easy to see.
We have a lot of questions, so we probably, since we're almost an hour now, let's get to the questions, and we can probably do another. We'll add to our webinar topics next month if people want to see more on this topic. Okay. Are Bollingers and Keltners simple or exponential moving averages? I use simples, Jack. I assume you do too.
Yeah.
Okay, great stuff, guys. Thank you, Graham. The email you're looking for, David, I just posted it in the questions tab, so you can get the email that you're looking for there. The Keltner overlay with Bollinger Bands for day trading, used on an hourly chart or a daily chart. You can use that on a 3-minute chart, Brett. I use that on a 1-minute chart, sometimes day trading, sometimes a 3-minute chart, sometimes a tick chart. Okay, so like for example, I will see a squeeze developing with a Keltner overlay on a 1-minute chart, and we'll get a 5-handle movement or a 10-handle movement. Okay, and my day's done. Okay, I see one setup like that, my day's done. I don't have to sit in front of the computer anymore. So, so the hourly chart and the daily chart is for swing trading. Like when I see 7 days of compression on a daily chart, I know there's 5 days of expansion coming. Okay, I can't wait to get in that trade. Okay, hourly chart, where you see that on an hourly chart, that's a trend day. A dead giveaway for a trend day is when you see enough hourly bars inside of Keltner channels. It's like the next day's a trend day. Okay, and when that overlaps with my other system that has to do with trend cycles, it's like it's a dead giveaway that there's a trend day coming. So anyway, okay, since you never know, this is a question for you, Jack. Since you never know the breakout direction, but the time spent in expansion is 80% of the time in compression, it seems there is always time to enter after the breakout. Is that correct?
I think the reality is people spend an awful lot of time trying to catch the exact turn, and the reality is I try to as well, because apart from the else, even if I'm not putting any money on it, then it's always nice to be able to call it exactly. But the reality is, if you miss it, it's generally better to arrive late than arrive early. You're generally better off shorting a lower high than trying to find the actual high.
Far lower risk.
So the reality is it's better to be late than early, because you may find the reversal you're looking for doesn't happen. In a strong trend, you will see wonderful setups just run over. Divergences, lovely pattern setups, head and shoulders, etc., and they will get demolished one after the other. Your head and shoulder will lose interest in being a head and shoulders halfway through the right shoulder and just head up. It's you get so many nice and actually a very good example yesterday with the falling wedge. Generally speaking, on a falling wedge, you can count on 38 to 61.8 being the retrace range if it's not going to be a full reversal. But if you're looking at a strong trend, then sometimes you only get 23.
Mm.
And that's exactly what we did yesterday. We got 23.
That's right.
It's and it just goes through. You can't count on anything 100%. Everything's got variation. The market itself will change, and you will have to adapt to it.
Yeah,
But
somebody will invent a new algo, and then all of a sudden, a system won't work anymore, or won't work as well, and you got to find something new.
But the reality is, using the mathematical tools at your disposal, and these all are mathematical tools of one kind or another. Using the mathematical tools at your disposal, you can tilt the odds to your advantage, and that's all you need.
We have a question here from Tom on what settings do you use for Bollinger Bands, Keltners, and RSI, and for what time periods, and how do they differ by time period? You can watch the recording, Tom, because we went over that in the recording, but just very quickly, Bollinger Bands typically second standard deviation or third. That's what Jack went over, and typically 20 days. Keltners typically 20 days, but also a exponential factor of 1.5 for the squeezes that I was talking about. And RSIs, it's a 5 period or a 14 usually, and I use 7 sometime on a monthly basis, but 5 and 14s are pretty common.
Yep.
Damon has a question. How do you determine the reliability rigidity of trend lines drawn on RSI, specifically hourly? The only thing I can tell you, Damon, is, and I'd like to hear your answer to this too, Jack, but for me, it has to do with feel. It has to do with drawing hundreds and thousands of those lines, and over time you get a feel for it, okay? It's not mechanical, in my estimation. And sometimes you have to not draw the line. And I can't really tell you when not to draw the line. It's not an easy thing to do. But I think if you start doing it, start observing your trading in relationship to it, you'll learn. I think that's the main thing to do, is put it on your chart and learn. That's my suggestion. But
I think the reality is, you use them, you watch them, you consider what the differences are, where it fails, where it works, and these things will become a normal part of your trading. And there are immensely useful tools for confirming or denying particular moves. The reality is, when you're looking at a potential breakup here and it never breaks this trend line, it's not going to happen.
The next question has to do with the put-call ratio and closing above the Bollinger Bands. That's a signal to sell, Fred. However, the next day you can still go higher. Okay, so you have to remember, it's not like an instant signal, but it means that you're very close to the top of the market. Okay, when it goes below, it's something to consider. It's not nearly as reliable. And intraday time frames, and you asked another question lower in terms of lower down the put call ratio. Can you use it on 5-minute basis? There's a system that exists for that, where you look at certain times of the day and how does the put call ratio change, and it's a way of actually predicting trend days. Okay, and we don't have the time to talk about it, and right now I don't use that system, nor do I even remember it. Okay, so it's a system that used to work. I've gotten away from it, but I would make some observations as to what happens an hour after. Program trading, really, program traders make decisions between 30 minutes after the open, so Central Time, that's 9 a.m., between 9 a.m. and 9:20, program traders make a big decision, okay, in terms of what's going to happen for the day, in terms of their time-based trading, okay? So between 9 and 9:30, which is really 10 and 10:30 Eastern Time, right, I would be watching the put-call ratio short-term, because that will give you clues about the day. It always does, okay? And I don't do that anymore, but I know a lot of people that rely on that, and it's a very useful system. There's a question here. For day trading, what candle time frames do you use? And that's for you, Jack.
Mainly, I will use primarily I'll use the 1-minute chart. This is my 1-minute chart. I'm generally only looking at 2 days, but I run the trend lines back over several days. I've loaded up to 5 days here. You see the trend lines, signals, etc. I mean, it all works. To be honest, it's exactly, you use the trend lines, you use the signals in pretty much exactly the same way you'd use them on the daily chart. It's just an awful lot faster. The patterns are just as reliable. I mean, there are mild variations as you go from a minute to a week as your candle size, but I mean, they essentially, the same stuff tends to, well, it performs similarly. Basically, you're just talking about going down from larger degrees to smaller degrees, right down to the limit of detection. It's, and they all work essentially by the same mathematical rules. I'll use the 1 minute chart a lot. I will use the 5 minute chart, and that isn't the 5 minute chart. This is the 5 minute chart. I'll use that quite a bit. I will also be aware of what's on the daily 60 and 15 minute charts, because the reality is that's where a train can be coming which you don't want to be.
Yeah, right.
Hit by.
Yeah.
Yeah,
careful.
I mean, having an idea of the overall context. I mean, you don't want to overthink your trading. You don't want to. I mean, price will guide you. You don't want to think, oh well, it's going to go up today and so on, because it might not. Nothing is reliable. No one knows the future, and the fact is, you know, the market tends to do what it wants. But you can tilt the odds in your favor. But if there is an obvious train heading in your direction, you need to be aware of it. So you still look at the upper time frames, but for intraday trades, really I'm just using mainly the 1, a fair amount of the 5, and a bit of the 15.
Great. Will you post this recording for reference? Yes, Graham, we will. It'll be up on the site sometime later tonight. Expansion time frame, 70 to 80% of the length of time. Bollinger Bands inside of Keltner says this apply on shorter time frame charts, mostly daily and hourly, Fred. When you get down to a 1 minute chart and you're doing this for squeezes during the day, like during a close or something like that, you can have like compression for 5 bars and then expansion for 15. Okay, so on a 1 minute basis, it's 70 to 80% it can work that way, but sometimes it greatly exceeds it. Okay, so there are higher time frames influencing the 1 minute time frame. This is a question for you, Jack, from David. The difference between an expanding and contracting triangle, megaphone versus a wedge.
There's essentially no difference. I would view those two and channels as effectively 3 variants of channels. Yep. I wouldn't really view them as megaphone or triangle. They are in effect a contracting channel, a channel, and a parallel channel, and an expanding channel. And that's the way I treat them and use them. It's and I think really that's something I've not read anywhere, and I don't think anyone's seeing them that way. But I was writing about this a couple of years ago, and in practical terms, that's how they work. And this is why Bulkowski has megaphones and wedges down as rather unreliable patterns in terms of making targets, because he's misunderstood the nature of the pattern. These are trending patterns. All trends essentially are variants of a channel.
Yep. Do all these tools work well on ES? Absolutely, they do.
Yeah.
And does global activity, when it's erratic, does it muddy the signals? Muddy
the price action.
Well, sure it does, but you know, when you use a lot of these signals together, okay, even when price is erratic, okay, they're very valuable. Like the limit down day, we traded support and resistance. We traded the RSI price cycle. We killed that day, okay, because of these tools that we're showing you. So they work, okay, and you just got to learn how to use them, and you got to use them on different time frames. So like when price is erratic, do you trade a 1 minute chart? No, you back out to a 15 or an hourly chart. When you get, you know, a VIX when the VIX is 50, guys, you can't trade a 1 minute chart. You know, so you have to learn based on volatility what time frame should you be looking at, and then using these tools appropriately at the right time or in the right time frame. It's very useful stuff, in my opinion.
The one thing I'd also add as well is, don't get obsessed by the news. There's a whole industry taking what happens to the markets and what's happened in the world and relating it together into cause and effect. Is it true? Well, I'm sure there's some influence on it, but actually, a lot of it's just pure garbage. It's just talking heads creating employment for themselves. It's a very natural tendency for everyone to want to become an amateur economist, and such is going to happen because of this, that, and the other. If you look at the track records of the actual PhD economists who publish their forecasts, they're awful. They are really terrible. What are your chances of beating them? Actually, not bad. Personally, I've wondered.
It's actually very good. Using these tools.
I wondered if they removed part of the brain as part of the PhD program. economics, but I think partially they train you not to think anything sensible as part of it.
Right.
Certainly, if you're going to work for the Fed. But but the thing is, the reality is, you've got an awful lot of very well qualified, intelligent people who make a complete pig's dinner of predicting anything.
Yeah.
So the reality is, no one's really going to be able to trade successfully on the basis of the news.
And there was a guy who made a post in the daily update subscription, and he said, really great job, guys, because you called the turn at 2014 and to 2020, whatever that area was, and the talking heads were saying it was going to go higher after the Fed meeting, and it didn't. And we were calling a turn right there, and that's exactly what happened. So, these tools, when you use them well, okay, you can hear the news, understand the news. It certainly helps to understand the news, but not rely on the news to trade. And I never rely on the news to trade, ever.
It's not a particularly useful addition to trading.
Yeah,
sometimes, I mean, the reality is, could you trade successfully just knowing about the news without any of these tools? No.
I don't think so.
Could you trade successfully just using these tools and without hearing any of the news? Yes, I think you could.
Yeah. Could you trade better by paying attention to one to both? Yeah, I think you can. I think it helps a little bit to be aware, of course.
But I think there's no question really about which one you need to be more aware of, and that is the mathematical tools at your disposal.
And Praveen says, thank you, Stan and Jack, and I want to say thank you, Praveen, and thank you everybody for coming today to the. We're at the bottom of the question list, Jack, and how appropriate. The very last comment is thank you, and so thank you, everybody. Thank you, Jack. Great job as always.
Yeah, thanks, Dan.
And enjoyed this. Jack and I have been working together since last October, doing chart chats and so forth. Well, actually, we've been working together much longer than that, because we go all the way back years together in trading rooms together. But I've never heard you talk about Bollinger Bands before or RSI before. We just talk tech. We just exchange TA all the time, and so this was very interesting, and I really
it is. I mean, we tend to communicate through the charts.
Yeah, right. Oh, yeah, well,
we show each other charts, and we see interesting things on each other's. But,
yeah, right, exactly.
I mean, the support trend lines on RSI, I never really used those tools. I started working with Stan, but I mean, they really work.
Yeah, it's great stuff. Absolutely great stuff. Yeah. So everybody, this will be up as soon as we get it converted and edited and then uploaded. It's going to take an hour. It always does, but it'll be posted soon tonight. So everybody take care. Good luck tomorrow trading, and see you at the next webinar next Thursday.
Quite so.
All right, take care. Thank you, Jack.
Thanks, Dan.